Well, we think that the divergence that you're seeing in earnings really do create opportunities for picking stocks, and that's something that we're taking advantage of at the Hodges funds. But in cases like Caterpillar and FedEx, what we see there is really transitory issues that we think are really created by a lot of the trade uncertainty out there, and you can take advantage of those. And I think the market is responding to that.
Kevin, what about you?
Yeah, I think as opposed to focusing on some of those larger multinational industrial names, let's look at some of the positives. We've had 84% of companies thus far beat on earnings, 64% beat on revenues, and some of the beats are in areas of consumer discretionary and consumer staples that show the strength of the U.S. consumer. Consider Domino's, consider Pepsi. And we think it's the strength of the U.S. consumer that's going to propel us into a record holiday shopping season and perhaps bode well for the stocks market in the fourth quarter.
How do you invest around that, though? I mean, the consumer staples names are trading pretty rich, a lot of them. Consumer discretionary, the winners and losers there have been pretty clear cut.
Yeah, I think consumer discretionary and riding the strength of the U.S. consumer, a large portion of that focuses around online commerce. We do think this will be a record year for online commerce, not just on Cyber Monday, but throughout the entire month of December. So it's the names like Amazon and all the other companies and industries that surround Amazon and online commerce players in the e-commerce ecosystem.
Eric, let me turn to you. We had a guest on yesterday who said that his base case is that the S&P will go up another 3% between now and year end based on earnings, seasonal factors, and the rest, and that 2020 is going to follow on and be a pretty good year for stocks. Do you share that view? And what sort of percentage probability would you put on the possibility that there is a big correction in 2020?
Well, I think, you're always going to have periodic corrections. It's a healthy thing for the market. But one thing that gives us a little bit of comfort, Bob, is the fact that investor sentiment is still relatively negative. You saw Morningstar report that in the third quarter, something like $60 billion left equity mutual funds and ETFs. And that was the highest since 2009. And those type of outflows out of equities don't happen near market peaks or right ahead of corrections. And I think the fact that sentiment has been so negative really tells you that there's a lot of money on the sidelines. And I think that there's still a lot of buying left to occur in the market over the next few months.